The S&P 500 is pretty flat on the year, but there's been a lot of movement in this first 5 months of the year. David Kudla, founder, chief executive officer, and chief investment strategist at Mainstay Capital Management, joins us via Zoom from Troy, Michigan. David, it's almost like the market's kind of made its peace here with a higher tariff environment wherever this thing shakes out. What does it mean for a money manager?
Yeah, well, you're talking about the round trip, right?
Yeah.
Where we went down through April 7th, and we've come all the way back. If you look at where we are today compared to 2 months ago, we're about the same level, but a lot of volatility in between. And really what this is the Trump put in action. And that is, what happened is he came out here over these, past couple of weeks, but especially when they made the deal with China, even if only for 90 days, that was the biggest risk for stocks really in the first half of the year. I think now we're a little bit more worried about long-term bonds and what those higher yields will mean for the market. We're seeing the risk shift because the tariff picture has gotten a little more clear, expecting more deals to come. But that's really what it is. The thing is with this Trump put is we're always just one social media post away from another market decline or another market gain. And it really is at the whim of what President Trump is saying or doing on any given day that is driving the markets and driving wild volatility into the markets over the past 2 months.
Yeah, but haven't we learned, though, that there is a Trump put? The puts may be in the bond market, but there is one. So now are we reconditioned to buying the dip? I mean, retail got it right.
Yeah, retail got it right. And look at where we are today. Earnings didn't collapse. We ended up with great earnings above 12% for the first quarter. We've got a tax deal that just passed the House. It's going to be a problem for bonds because of what it adds to the deficit and debt, $3.8 trillion as it stands now. We'll see what happens in the Senate. But for stocks, it's fiscal stimulus. And, if we have the trade deal with China for the next 90 days, if anything, the permanent deal will be that or less in terms of tariff is what we believe. So you look at and the bullish nature of buybacks, which are in high gear right now in May, as buyback seasons come back in, we're going to set records for corporate buybacks again. So there's a lot to like about stocks right now, and investors have just priced that back in.
So what screens well for you these days, David? I mean, it looks like we do have a higher tariff limit, whether it's 18% weighted average today or something maybe even lower. Probably lower earnings growth here. Where do you see, I guess, attractive opportunities?
Yeah, and I'll tell you, we're, as much as I say it's very nice how the markets come back. We are cautious on the markets to a degree in 2025. Because of some of the risks that are on the horizon, the biggest being what happens with long-term bond yields, what we've been seeing here these past days. And so we like gold. We like gold for a lot of reasons, from what's happening to it as a reserve currency to, so that's creating demand at central banks. The fear trade, it's the ultimate fear trade. So we've been bullish on gold, continue to be. We hold it in all our portfolios, full disclosure, all of our tactical portfolios. We're short JGBs. We're short Japanese government bonds. We've seen what's happened with the meltdown over there. And
are you short on the long end, David, for those?
Yeah, I'm sorry, on the long end, yeah. And as I've been talking about on the show for 5-6 months now, we like Europe this year. We think Europe's going to outperform the U.S. markets by a very wide margin.
And what's the catalyst for that, I guess? Because, or has that catalyst already worked its way out? Many say that, well, the ECB is going to be a lot more dovish than the Fed, and that's sort of the nice catalyst for Europe. But then you have John Williams saying today that potentially if tariffs come down to 10%, you could see that cut in July. Yeah,
well, I don't think we're going to see a cut in July. The the forecast of 3 to 5 rate cuts over the next year or so, that's not going to happen. I'll take the under on that every day of the week. We're not going to see the Fed cutting. In Europe, the ECB is cutting. They don't have as much of an inflation problem. The ECB is cutting, and they have fiscal stimulus because of the pullback in NATO. So we have Germany has their own $1 trillion euro stimulus package, fiscal stimulus package. The EU and the euro together, another 800 trillion. So we have fiscal stimulus. We have monetary stimulus. Compare that to the U.S. We have essentially, from a fiscal standpoint, we have some help with the tax cut package, but from a monetary standpoint, this is the problem for the Fed. We've said often the Fed is between a rock and a hard place. They're between a rock and a hard place right now. If they were to cut right now, what do you think would happen? What would be the reaction function? We would see the 10-year and 30-year bond go higher. The bond vigilantes would come in full steam ahead, hotter than heck, and raise the long end of the curve. So what will the Fed do? They'll print. The Fed will print money, and that's going to add liquidity in the near term, but certainly not a good thing for the long term. We know that.
David, always great catching up with you. David Kudla, founder, chief executive officer, and chief investment strategist at Mainstay Capital Management.